In this video, we're going to try come up with a working definition for both speculators and gamblers in the economy. So I think it's quite an interesting thing to think about the difference between speculators and gamblers. And there's various kind of investment opportunities that people might believe in, but then others will come in and say, this is just effectively gambling, it's just hidden behind some more complicated process. Or perhaps you feel like there's calculated gambling at play, so it might be gambling for some participants, but then other participants believe they have some sort of an edge. And so then you wonder, is there kind of a key difference between speculators and gamblers? How can we go about defining this difference? And so I suppose with that difference then, you'd hopefully be able to make some more interesting analysis down the road in various financial markets, by understanding the difference between speculators and gamblers. Okay, so let's get into it. So here are the definitions that I've settled on a few years ago, and they aren't the most precise definitions in the world, but I think they're quite beneficial nonetheless. So in order to specify our definitions, I'd like to observe kind of a spectrum in the market between stability and uncertainty. So various assets lie somewhere on this spectrum. So for example, currency is supposed to act as a more stable asset, as opposed to investments that add more risk to the table, and this is in the hopes for some tasty profit. So I think this spectrum is definitely something observable. So with that out of the way, we're going to use this idea of stability and uncertainty as the core property, the core characteristic to distinguish speculators and gamblers. So let's start with a speculator. So a speculator is someone who adds uncertainty to their financial portfolio, but specifically, a speculator is someone who demands an additional reward for taking on this uncertainty, since otherwise they would just prefer a more stable financial situation. And even if the expected outcome of this speculation is neutral, the volatility added to their portfolio causes them to push for an additional premium to make the expected outcome positive. So the higher the volatility, the higher the premium they will want to secure. So some common examples then that I think fall into this speculator category would be the likes of an insurance provider, for example, or a liquidity provider, or a bookmaker. So they're on the opposite side of gambling. So they're the ones trying to make profits from gamblers. So this then leads into the definition of a gambler. So a gambler is also someone who adds uncertainty to their financial portfolio. However, the distinction of interest here is that a gambler is someone who pays to have the opportunity to take on this uncertainty, since they would prefer a more volatile situation over a stable one. So they'll happily accept a negative expected outcome if the possibility for profit is quite high. And gamblers perhaps would also include those who take on an expected return of 0. So if it's 0 or less, then it would be gambling, and if it's greater than 0, then it would be speculation. So then some examples of gambling could be, casino gambling or horse betting. And there's actually some interesting crypto gambling products available now in recent years. Please do not waste any of your money on those. So as I was saying, the key difference between a speculator and a gambler is that speculators want to be paid for taking on additional uncertainty, whereas gamblers are willing to pay for this added uncertainty. So perhaps then it's interesting to see, well, what if I'm not sure if I'm a gambler or a speculator, and then I'm actually gambling on the fact that I am a speculator? So you believe, I think I have some edge in the market, I'm going to classify myself as a speculator, but really there's an element of uncertainty to that, and the question is, am I speculating on whether I am a speculator, or am I in fact just gambling on the fact that I'm a speculator? And if that turns out not to be the case, then I would actually be the worst gambler of all. So I suppose with that out of the way, I was going to leave this for another video, but I think I will just discuss this now. Let's use these definitions that aim to capture the key intuitive characteristics that one might expect to associate with such participants, and use this to interpret the derivatives market, and let's see if there's any significance to that interpretation. So we'd like to see, does the derivatives market consist of both speculators and gamblers, or would it be perhaps more like the spot market, where a lot of participants seem to believe that the spot market is a form of speculation and not gambling. So let's recall that the derivatives market is an enormous market which is jam-packed with traders betting against each other on asset prices without actually holding these assets. So that's the idea of the derivatives market, is that we're creating a derivative behind these assets. and so you're not actually holding the real physical assets. Now, one particular type of derivatives market is the futures market, and here users can choose to long or short on asset prices. They can select a level of leverage for their needs, which adjusts the sensitivity of their portfolio value to fluctuations in prices. Now, a specific type of futures market is the perpetual futures market, and this has actually only come to fruition in recent years, since the explosion of crypto trading. So one of those old exchanges many years ago, like, I don't know what it was, like Bybit or Bitfinex or something that starts with the letter B. Just give me 1 second, I'll have a look. Okay, so my bad. So it seems it was BitMEX who first introduced the perpetual futures exchange in 2016. And actually it turns out that this was originally proposed by someone called Robert Schiller in 1992. So it's interesting actually, so that's 8 years to 2016 after that. So that's 24 years actually until someone used this idea of the perpetuals market and actually put it into action. So now I'd like to go ahead and claim that the perpetual futures market consists of both speculators and gamblers. And without both of them, it cannot function. And that does become quite interesting, because then if you are a user of the perpetuals market, then you do have to ask yourself, am I on the gambling side or am I on the speculation side? So to be honest, it's not really that difficult to see why the perpetuals market needs both speculators and gamblers. Although we'll actually see an interesting way where it's kind of wishy-washy on whether someone is considered a speculator or a gambler, and that will require going into more detail of describing the notion of an investment portfolio. So we'll get into that later on in this video, I think, if we have time. So really you should familiarize yourself a little bit with perpetual futures. Maybe I'll just give a quick summary here. So the perpetual futures market is like the normal futures market. So the normal futures market, you're betting on some derivative assets, so not real assets, but they have an expiry date, so they settle to real assets on those expiry dates. And that's what causes traders to trade the price similar to the real underlying price. So it can fluctuate a bit, but it kind of tends to follow a similar trajectory. So if the spot price increases, then the futures price will likely follow. Now, perpetual futures, on the other hand, takes us a step further by deciding we're not going to have any expiry date whatsoever. So they just decide, let's roll over the contracts every so often to keep this contract going indefinitely. And it is interesting to see, well, if it goes on indefinitely, then how can are users guaranteed to be able to opt out? Do we need other users to come in to help them opt out? So essentially, newer users are buying the old user out of the system. It does get quite interesting, the whole process on how you even kickstart the system in the first place. And I think maybe in a future video I might try to kind of rebuild the concepts of a perpetual market from scratch, kind of introduce properties piece by piece to build up a market from scratch that behaves like the perpetuals market, and see if we can make any interesting observations on that process. But anyway, I think I keep going on a tangent. So how does this perpetual futures market work in particular? Well, it uses the key funding fee process, and this is a sum of the interest rate and just the raw funding rate. Now, this interest rate seems to be slowly getting abolished by various exchanges. I don't see the purpose of it in the first place. It doesn't really... All it seems to do is introduce various inefficiencies into the whole system. But anyway, so there is a funding rate that traders are paying. So when they have a position open, every 8 hours, or depends on the exchange, but every exchange I know anyway does it on an 8-hour basis, you will have to pay a funding rate to compensate for the price of the derivative asset deviating from the underlying asset. So since the contract never expires, never physically expires, then how can they ensure that the price matches the underlying asset? So what happens is, if the price is too high or if the price is too low, the side of traders that pay the funding rate changes. So we have your longs and you have your shorts. If the price is too high, then the longs are going to be paying the shorts the funding rate, and that's going to add some sell pressure into the market, bring the price back down. And on the other way around, if the price is below the underlying price, then the short side are going to be paying the longer's funding rate to introduce some buy pressure into the market. Exact same thing there. So I just lost my train of thought there because I'm thinking of treating myself to some delicious fast food, maybe after I'm finished recording this. So we were talking about these funding fees, and the funding fee does depend on how far away the derivative asset is from the underlying asset. So if it's significantly far away, the funding fee will be higher. Now there's so many interesting observations to make about this funding fee, and in practice I believe the perpetuals market is absolute horseshit, but that will be left for another video. But let's get back into this notion of speculation and gambling and see how this plays into the perpetuals market. Okay, so the claim I'd like to make is that the perpetuals market hinges on gamblers to operate, and speculators alone will not suffice. And we might get into a few consequences of this near the end of the video. So this claim will assume that the spot market is a form of speculation as opposed to gambling. If the spot market is itself also just gambling, then I suppose everything else that's a derivative of that is probably just going to be gambling entirely. So if we assume that that's speculation, then what we'd like to show is the perpetuals market still is going to introduce gambling into the whole system. So we do kind of tend to believe the stock market is a form of speculation, as it's commonly accepted that fiat currency deteriorates in value even during economic growth, and thus gets outperformed by the stock market. And that's if we're using the currency as a reference point. And this whole speculation gambling definition, we can use different reference points entirely. And so it's very subjective then, what reference point are we using? So we can only really define these notions with respect to a particular reference point. So just keep that at the back of your mind, but I'm just going to assume that we're working with the reference point of currency, and so in this case the stock market is a form of speculation, at least for those who believe the stock market outperforms currency. So now with perpetual futures, funds are only transferred between users, so don't forget that. So profits and losses are transferred between users, so there's no external injection of funds or any external way of losing funds in the system. All the profits and losses are internal. So if one user makes a profit, then we have another user losing. So this means that every long position requires an equal and opposite short position, as otherwise potential profits could not be paid out. And this then comes in tandem with the requirement for an equal balance between buyers and sellers, which is already seen in the spot market. So in order for the swap price to track the underlying spot price, funding fees have to be introduced. So this can be thought of as a peer-to-peer premium between longs and shorts, and it incentivizes users to open positions on a particular side. So that's causing pressure on the price to bring it closer to the spot price. So the funding fee is automatically adjusted as the swap price deviates in a particular direction from the spot price. So now let's look at two scenarios where either the longs or the shorts are speculators, and from there we will imply that the opposite side must consist of gamblers. And hence we will be able to conclude that both sides cannot be speculators, and at least one side must be made up of gamblers. So let's consider the first case where the long side consists of speculators. So for this to be possible, the funding rate must be zero, as otherwise they are better off in the spot market. Now indeed, if you do leverage in the spot market, you do have this interest rate, but you also have these users that are not leveraged, that are at an advantage by not having this interest rate, and so they're going to be putting a lot of pressure on the market. So in reality, the average funding rate needs to be less than or equal to the spot interest rate. So if the interest rate they pay is more than the average spot market return, it would imply that they are gamblers and not speculators. So because we're assuming they're speculators, we can infer that the funding rate is less than or equal to the spot market interest rate. So now the shorters are not being sufficiently rewarded with funding fees to take on this risk. Since the stock market outperforms the currency that is used as the denominator of the trading pair, the shorters have an opposite expected outcome. So what that means is they will do worse than the denominated currency. So the furthest the funding fee can offset this is such that the expected return is zero. Also, shorting is a very risky endeavour because they face the risk of liquidation and also have a different payout structure. But we can conclude that shorters will on average lose money in these circumstances, and therefore they are gamblers and are paying on to they are paying to take on this uncertainty. Now let's suppose instead the second case where the short side consists of speculators, and so that they're getting fairly rewarded for their risk taking. In this case, the shorters are demanding a funding fee greater than the spot market interest rate, and hence the longers are paying more in funding fees than the average spot market return. So this means their risk taking is now not fairly compensated, and they will on average lose money. So therefore they are now considered gamblers in these circumstances and are paying to take on this uncertainty. So overall, at least one side must amount to gambling. And this can also easily be seen by noticing that the perpetual market is a zero-sum game relative to the denominated currency. So the key here is that we're looking at it relative to the denominated currency. So again, it is depending on what reference point of interest you are considering and how the definition of speculation and gambling comes into play. But given the zero-sum game nature, further to be a speculator who outperforms the denominator on average, then there must be a gambler who performs worse than the denominator on average. So what this means is, what the significance of this claim is that at least one side of perpetual trading, if not both, is an act of gambling. Now this doesn't mean you can't win, of course you can, but the average trader will likely lose money. Of course then, calculated gambling could come in, so you could genuinely gain information that allows you to outperform everyone else and take their money. You may have identified a trading strategy that has better odds than everyone else, just how some people manage to consistently beat the bookies. But this would be an exceptional situation, a loophole of sorts, that wouldn't last forever. So remember that market odds adjust dynamically from traders' actions to the point where a working strategy will become ineffective once people start using it. So you can think of these exceptional strategies as arbitrage rather than just regular trading, and then you'll understand why they can't last. So it's surprising to see that it's rarely the short side who are gambling, but generally the long side as well. It's hard to understand why investors even use perpetual futures when the spot market is better, until you realize, of course, that there are no investors living in the perpetual market. If you're trading perpetual, the only people you are with are gamblers, those who want the added fun of high leverage and who are willing to pay a premium to do so. And that premium goes to shorters to make the odds ever so slightly more in their favour, but still with a negative expected return. So if you're in the perpetual market, you need to ask yourself, are you okay with gambling? Now the only exception to this claim is in the cases of arbitrage or hedging or insurance, where you are actually intentionally adding volatility that counteracts an opposite form of uncertainty that you are facing in a business. So clearly in such cases the characteristics of gambling become irrelevant, as a negative expected return in isolation forms part of a larger conceptual portfolio, where its constituent parts might not tell the whole story. So the question is, what level do we consider a single investment portfolio to be? So is that a single business? Is that a single actual real human being? So each human perhaps only has one investment portfolio, and it is interesting to decide what level of granularity we have for investment portfolios. So of course, if we do have some smaller individual portfolios, they may individually be gambling because they're adding uncertainty, they're paying to add uncertainty. But when you combine these portfolios into one larger conceptual portfolio, then you can actually strategically add uncertainty for the purpose of hedging. So you have to consider really the largest portfolio that's appropriate to your analysis, and then you can then determine, is this speculation or gambling? So in the case of just an individual person, you literally just combine all your investments. You yourself have one entire portfolio. And then businesses, on the other hand, it could be different because you're then interested in what real people, what human beings are invested in those businesses, and the share they have in the business and how that affects them personally. So there's really a lot to get into there. So I suppose the claims we're making about the perpetual market do assume we're working in these isolated portfolios, where gambling in the isolated portfolio is what we're interested in studying. But yeah, if this does form part of a larger portfolio, then that gambling nature can be cancelled out. So maybe that's something I'll look into more another time. But what's interesting about this is that a natural speculation-based economic equilibrium cannot develop here from funding fees in the perpetuals market. So the laws of economics will not kick in to save you by providing a fair risk-reward ratio. So oftentimes when we're trading, we're thinking that there's perhaps a reasonably fair risk-reward situation at play, and that's because economics does a fairly good job of forming an equilibrium. However, that is based on usually kind of a speculation-based equilibrium, and these laws of economics then take effect. But rather, in this case, the market forces are solely coming from gamblers, resulting in a sort of gambling-based equilibrium, and so that's kind of a negative outcome. So if there were no gamblers, such a derivatives market could not even exist. So I suppose what we can gather from that is we cannot just trust that the odds perhaps are close enough to being in our favour. So you can't just assume, well, even if I don't win, that the odds are close enough to being in my favour, because this normal speculation-based equilibrium is not at play. Anyway, I think this video has dragged on too much. There's really a lot to think about, really concretely defining speculators and gamblers, considering the notion of an investment portfolio, and how kind of defining that relative to a reference point, whether that's relative to a currency of interest or a more abstract notion, and then you can definitely formalize new notions from that. So there's definitely a lot of future research that can be done on this topic. This has been a bit of a rambly video. I don't usually do unscripted videos. Now I was reading through a few bullet points in an article I wrote a few years ago, just to use in this video, but I probably waffled quite a bit, so that's quite new for me. So thank you for watching anyway this video. I hope that was interesting. I'd love to hear your thoughts in the comments, and I will see you all next time.